One system administrator left Cascade Payroll 8 months ago. His credentials still work. The dollar amount attached to that account is zero. No transaction, no loss, nothing to add up. So is it material? In a financial statement audit, you would reach for a number to answer that. In a SOC engagement, there is no number to reach for, and that is not a gap in the standards. That is the point. Welcome back. I'm Professor Lamptey. This is part 2 of planning a SOC engagement. In part 1, we covered what has to be true before you accept and how to understand the service organization system. Now, 3 things: how materiality works with no financial statements to measure against, the risks the service auditor assesses, and how those risks shape the work. Same example throughout: Cascade Payroll Solutions, a payroll processor with 380 client companies, engaging us for a SOC 1 Type 2. Start with materiality. Materiality is a threshold question. How big does a problem have to be before it changes someone's decision? In a financial statement audit, that threshold is anchored to one company's numbers, a percentage of revenue or assets or pre-tax income. Cascade has 380 client companies, each with its own financial statements and its own threshold. We do not know any of them, and we are not trying to. The standard is explicit here. Materiality relates to the system being reported on, not to the financial statements of the user entities. So instead of one company's numbers, we consider the common information needs of a broad range of user entities and their auditors as a group. Materiality attaches to different things in different ways. For the description of the system and for the design of the controls, the judgment is mostly qualitative. Does the description cover the significant parts of processing? Would the controls, as designed, actually achieve the control objective? For operating effectiveness, there is a number involved, but probably not the number you expect. The quantitative side is the tolerable rate of deviation measured against the observed rate. Tolerable rate is the maximum rate of deviation we are willing to accept before that level of failure changes our planned conclusion about the control. Observed rate is how often it actually failed in our sample. So at Cascade, we test 40 payroll approvals and find one released without sign-off. Whether that matters depends on the tolerable rate we set going in. The qualitative side is the nature and the cause of that deviation. One rushed approval during a holiday week is a different problem from a manager who never approves anything. Volume, dollar magnitude, and control frequency still matter. They shape scoping and risk assessment, but they are not the materiality benchmark. And one more rule, which surprises people. Materiality does not apply when we disclose our test results. If we find a deviation, we report it. The extent of testing, the sample size, and the number and nature of the deviations. We report it even when we conclude the control objective was still achieved. Why? Because a deviation that is not significant to our overall opinion may be very significant to one particular user entity. That terminated administrator from the top of the video is exactly that case. $0 and a serious problem for whichever client's data sat behind it. That judgment belongs to the user entity and its auditor. It does not belong to us. Now to risk. Once we understand the system, we assess the risk of material misstatement. The risk that what we are reporting on is wrong in a way that matters. It has 3 parts because the subject matter has 3 parts. First, the risk that the description is not fairly presented. Cascade claims it does something it does not actually do, or the description quietly leaves out a system that matters. Second, the risk that the controls are not suitably designed. Even if the staff performed the control exactly as written, it still would not achieve the control objective. Third, in a Type 2, the risk that the controls did not operate effectively throughout the period. One vocabulary note because the exam separates these. Those 3 are the risk of material misstatement. Add detection risk and you have attestation risk. They are not the same thing. That third risk is what separates a Type 2 from a Type 1. A Type 1 report covers the description and the design and implementation of the controls as of one specified date, a snapshot. It contains no description of tests and results. A Type 2 covers all 3 elements throughout the period. That is why a user auditor who needs evidence about operating effectiveness over a period looks to a Type 2. A Type 1 can help with design and implementation as of a date, but it does not tell us whether the controls operated effectively throughout a period. We also do not assess risk as one number. Risk varies a great deal across control objectives. At Cascade, the automated gross to net payroll calculation is probably low risk. It is standardized, and the software does the work. Privileged access administration is a different story, and so is program change management. Both depend on people making judgments, and both are high risk. What pushes risk up? Major system changes, a conversion during the period, turnover among the people who perform key controls, complex technology, problems in prior periods, and one more that is easy to be polite about. Cascade wrote the description and has a commercial interest in it reading well. That does not mean management is dishonest. It means we exercise professional skepticism, a questioning mind, a critical look at the evidence. And when an answer is vague or implausible, the standards require us to investigate. Risk assessment is not a document we file and forget. It sets the nature, the timing, and the extent of everything that follows. Nature is what kind of procedure. Timing is when in the period. Extent is how much we test. Higher risk means more persuasive evidence, larger samples, and testing at several points in the period rather than one pass at the end. For a Type 2, that is not optional. We are opining on operating effectiveness throughout the period, so our evidence has to cover the period. One principle runs through all of it, and it is a requirement, not a preference. Inquiry alone is not enough. We ask, of course, but we then perform other procedures in combination with inquiry to establish how the control was applied, how consistently, and by whom or by what means. In practice, that means observation, inspection, and re-performance. The combination depends on the control. We also build the team around the risks we identified. Who has the IT expertise to test access controls and program change management? And does Cascade have an internal audit function whose work we could use? If we plan to use it, we first evaluate that function's objectivity, how independent it is inside Cascade, and its competence. Then we re-perform some of the work we plan to rely on. Two things to remember. Our opinion makes no reference to internal audit's work. There is no sharing of responsibility. And in a Type 2, the description of tests has to describe that work and ours. Then we document the chain, what we understood, what risks we identified, and what procedures we designed, so a reviewer can follow the line from risk to work without asking us. Step back for a moment. A SOC report creates real leverage. One service auditor performs one engagement, and many user entities and their auditors rely on the report. That is why planning carries so much weight. Accept an engagement you should have declined, draw the system boundary in the wrong place, miss a subservice organization, or set the risk on a poorly designed control too low. Careful testing later does not repair a planning decision that was wrong from the start. Planning is where the foundation of a SOC engagement is built. Let's bring both halves together before we accept independence and competence, management's responsibilities and its written assertion, suitable and available criteria, and a scope that produces a useful report. Then the system. Draw the boundary, work the 5 components, decide carve out or inclusive, identify the complementary controls on both sides. On materiality, there is no financial statement benchmark. Description and design are mostly qualitative. Operating effectiveness weighs the tolerable rate of deviation against the observed rate, and materiality never applies to reporting deviations. Everyone gets disclosed. Then the risk of material misstatement across all 3 elements, the description, the design, and for a Type 2, operating effectiveness throughout the period. And finally, let those risks drive the nature, timing, and extent of the work. Inquiry alone is never enough. If that made SOC planning clearer, subscribe. We are working straight through the ISC material. Next, we move from planning to performance. How the service auditor gathers evidence, tests controls, evaluates deviations, and decides what those findings mean for the final report. I'll see you there.